we'll get going here. I'm sure there'll be a couple more stragglers filing in, but excited to have everyone here for our live webinar. Again, this is FX Bootcamp, the ultimate guide to cash flow hedging. Really excited for this one. We've got Greg Dalzell from GPS Capital Markets doing, he's one of our foremost sales and traders. Loads of experience, really knows what he's doing, fantastic. And then Tim Potter, managing director over at HedgeStar, to talk to us about cash flow hedging and how you can structure some of these situations that you run into or clients might run into. So let's. I'm just going to keep this moving along here. Like I said, so we two companies here: GPS Capital Markets from the FX side, HedgeStar from the commodities side. A few housekeeping items here for those of you that are here for a CPE credit. You will, at the conclusion of this, be able to be qualified for a CPE credit. And this is going to be recorded and distributed after the fact for that. Throughout the presentation, in order to get credit, you do have to answer some engagement questions. Just some little polls we're going to throw up. There's going to be 3 questions that are going to appear throughout the presentation, and we'll throw those up in teams. You'll just respond. We might talk about some of them a little bit as part of it. So everyone will be placed on mute. Just as a reminder, if you'd like to ask a question, use the question box in your control panel. So we can get to those and have those saved and responded to either during the presentation. We'll also have a Q&A session at the end to hopefully address any of those questions or intriguing situations you might think of as we go. So I will just jump in here. I think, if I remember right, we are going to be kicking it off with our first poll question, and I'll send it over to Greg to go over this with us here. Let me pull that question.
Good morning, everyone. I'm Greg Dalzell with GPS. As Andy mentioned, there's a poll question up here to start off with. A little bit about myself. I've been in the markets in FX specifically for quite a long time. I started off as a trader and market maker in New York and Chicago a long time ago. That particular role has been mostly eliminated now from technology, which isn't really a bad thing because that job was really quite stressful. For the last couple of decades, to be honest, I've worked with clients helping to identify and manage their foreign exchange needs, both in the Pacific Northwest, running a team Oregon, Washington, Western Canada, and Alaska, and then also in the Bay Area working with my employers, technology companies. So I have a pretty good, well-rounded understanding of what our clients' needs are, but we'd like to start off with really, what's been the major obstacle preventing your organization from implementing a cash flow hedging program. So if you can go ahead and click what the most meaningful of those buttons, and we'll get a quick response from you.
We still have some other responses coming in. They're kind of trickling in. While we're waiting for the rest of those, while we're here, Tim, why don't you give yourself a little introduction? Let us know more about you and your background as well.
Sure. Yeah, appreciate it. And hi, everybody. I'm Tim Potter, Managing Director with HedgeStar. Happy to be here with you all and alongside Greg and the GPS team. HedgeStar, we are an outsourced hedge accounting solution for our clients. So we help clients navigate the technicalities of US GAAP and the requirements to apply hedge accounting. We'll learn a little bit more about it later on, but hedge accounting in a nutshell will mitigate the volatility that would otherwise be present in financial statements while carrying derivatives and using those to hedge. So there's formal steps to take in order to get preferential accounting treatment and designate those derivatives as hedging instruments for financial reporting.
Cool. Awesome. Thanks so much, Tim.
Yep.
Cool. I'm going to close the poll here in 3, 2, 1. Yeah, in the meeting chat, you can see there we've got, looks like we've got 10% said no major financial impact. Nobody said difficult forecasting cash exposures. We have 40% or 8 respondents saying hedge accounting is complex. 5%, one person said perceived as speculative. And 9 respondents or 45% said lack of expertise and resources.
Okay, so I've seen a number of polls asking the same question, and this is pretty much, this tracks pretty well with polls I've seen in the past. So hopefully we'll be able to address some of these pain points for you to help you get a better understanding moving forward. So why don't we go ahead with our first slide from the presentation. What is a cash flow hedge? And to be honest, I went on the internet to see if I could get a good answer on that. Just a couple slides back, Andy.
Oh, sorry. Jumped ahead. There you go.
And I didn't like any of them. Sorry, Tim, but I think they're all written by accountants. So I came up with my own definition here. And the key element is there's variability in these future cash flows, or whether it's that or the amount is predetermined. The key is that the future transactions are highly probable, but they're not yet recorded on a company's financial statements, but they expect to be. So they're not yet recorded on the financial statements, so they're not booked. For instance, I know I'm going to be receiving euros every month this year. I have for the last 5 years, and I want to make sure I get the dollar equivalent of those euro sales. But if and this is why it's great to have Tim involved, because since there's nothing on your books other than the impact to margins, if you place a hedge to lock in the dollar equivalent, the remeasurement of that hedge is going to add volatility to your income statement without hedge accounting. And so what hedge accounting does, it doesn't change the financials of the transaction at all. It just creates favorable timing, so the actual underlying exposure and the derivative that you're putting in place to hedge that are recognized in the same period. We're coming up to budget season for most companies, so I think this is a great time to have this conversation. I've seen every type of process involved in how companies come up with their FX budget rates, where it's super detailed, where they'll take 10 different providers' forecasts, drop the highest and lowest, and then take the average. Or some of them just pick out the rate from a Wanda or the Wall Street Journal today. Every iteration of it. What my recommendation is you use the forward rate, the rate that you could hedge at. And so what's really funny is they'll go through all this process to create a budget rate, and they go, okay, we got a budget rate for the year. This is what we expect to make on our euro sales, dollar equivalent. And then a lot of times companies just walk away from it. So you put all this work into coming up with a budget rate, but you haven't done anything really to help you achieve that budget rate, so that this rate that you placed is near the actual rate that flows through your consolidated financial statements. So a cash flow hedge is particularly good at helping a company achieve a rate that is at or close to their budget rate if they use the forward rate to hedge as their budget rate, and they place a hedge at the same time they set the budget rate. So it's a pretty straightforward process. It's not really hard. That was just one example, but Andy, if you could go to the next slide, we'll look at this is the exposure timeline. And if you've been involved in the markets for a while for FX, you've seen something similar to this. And at the far right is the cash event. That's when your company actually receives the euros and it gets converted into dollars, to use my prior example. At some point prior to that, this forecasted transaction was actually booked. So now you have a receivable in euros. And if it's at the US parent, the remeasurement of that flows through the P&L. Now, prior to that recording time, this is where your forecasted transaction is. and that's where the cash flow hedge is initiated. And basically, when you set the budget rate, you're on the clock as far as your exposure goes. So if you set your budget rate in September for your revenue in euros, that's going to be January through December of 2025. Basically, in September, October, whenever you set that rate, you're on the clock for it. Now, if you're looking to really just smooth the impact of FX on your financial statements over the years, you may even want to start hedging to the left of the budget rate. Some companies, not a lot, but there's a fair amount of companies that will hedge 18 months, 2 years out of cash flow hedges just to smooth that process. So, just because the budget rate isn't necessarily the furthest out you'd go. And then when we look at different hedge instruments here for cash flow hedges, forward contracts far and away the most used. Probably about 90% of all cash flow hedges use forward contracts. Then there's options and options combinations, and then cross-currency swaps, which can go out 5 or even 10 years. A cross-currency swap is really most appropriate if you're hedging a loan or you're creating synthetic debt. Then you're going to probably use a cross-currency swap. But in most cases, and what we're going to look at today, it's going to be basically protecting the budget rate, protecting margins, and my default, because I like simple, is forward contracts. So let's look at some examples here of cash flow exposures. U.S. company with euro-denominated sales. Pretty easy to understand that. Now, a euro functional subsidiary purchasing inventory in dollars from the U.S. parent or a third party. That is actually a similar transaction. The actual exposure there is the same as the first one, in that as much as the hedge is selling euros in both of those instances. A U.S. company purchases inventory from Taiwan or China in local currency. We see that a lot in the Bay Area. That's also something that a lot of companies want to lock in the dollar equivalent of these purchases, the sourcing they're doing. Future progress payments in euro for heavy equipment. So if you're buying a big lathe from Germany and it's going to get delivered in 18 months, but there's a series of progress payments, that is something that a lot of companies would want to hedge as well. And then a U.S. parent loans pounds to its U.K. sub. The sub makes monthly pound-denominated interest payments back to the parent. So pretty straightforward exposure there. Euro or pound incoming into U.S. parent, that might be hedged. You might also use a cross-currency swap for that to hedge both the principal and the interest, or you can just do the interest. So 4 steps. Now, some parties out there have a 10-step program for this. I've got 4 here. The 10 steps is just further delineation of these 4. Now, when I started off on the sales side in this business, there was a guy giving a presentation. He was an old guy, just like me now, speaking to you guys. And he said, number 1 and number 4, far and away, the most important steps in here. And, I don't really want to hear that. Number 2 and 3 are the fun ones, at least for me. But as I've been in this business a while and I've met a lot of clients, far and away, number 1 is the most important thing. If you define the objectives right and you communicate it across your company so everyone's goals are aligned, everything else is much easier as far as this goes. So number 1, far and away, the most important. And then number 4 is really reviewing and monitoring. Are we meeting these objectives in number 1? And one question we get a lot, or a statement we get a lot, is, oh, I don't want to hedge because then I feel like I'm speculating. And, the reason they come up with this is a couple of them, but the main one is the objectives haven't been really well defined. And I find that particularly if you're hedging the budget rate, that's pretty straightforward. And it kind of takes away that, speculating thing, because you can understand why you're going through this budgeting process. Oh, okay, well, if we hedge this cash flow here, I understand I'm hedging at the budget rate, so it makes a little bit more sense. But those are the main four. I'm glad we're having this discussion kind of before everyone starts setting their budget for next year, budget rates, because this is something that you can really kind of take a look at. So what are some sample objectives? Like I said, smoothing the impact of changes in FX rates over time on a company's financial performance. Clients don't want 1 year of a very strong dollar to have a big impact, where the next year it's the opposite, right? If you can smooth that out, it makes it much easier to forecast. Protecting budgeted results, protecting gross margins. That's a big one. You're looking at revenue and expenses, hedging the cash flows there, protecting the budget rate. Assist senior management's ability to forecast financial performance. And then hedge rates are important input to pricing of goods and services. The order these are in are kind of the order that the reasons why people do it. And I think that probably for just about everybody, they can identify that, yeah, I need to hedge for one of these reasons here, or this would be my reason to do it. But the main thing is you want to make sure that what you're doing, what you're delivering to the financial statements is what your objective has been in the first place. Now here's the part that I kind of have fun with. I like figuring out what the risk is here. And I view this as a dentist or a doctor taking an x-ray to kind of get the lay of the land on a company's FX exposure. So if you see on the right here, you've got euro revenue net, you've got HUF expense, you've got pound expense, yen revenue, CNY expense, and then Canadian expense. Pretty big numbers. And then we're looking at quantifying what that risk is. And we call this the risk decomposition waterfall. The individual currency risk stacked on each other. And then there's an element of diversification here. So the total risk is about 25 million if you take the individual exposures and aggregate them. But we've got a lot of revenue and expense in different currencies. And so there's some diversification there. So the risk is eliminated down to about 9.7 million from diversification. Now, something that I hear a lot when I speak to a client that doesn't hedge, they may have a setup very similar to this. And they say, well, intuitively, I got revenue here, I got expenses over here, and I feel like I'm just kind of naturally hedged. And so we've never done any cash flow hedging or addressed any of these in the past. And we don't want to hedge one of them because it might take away that natural hedge element. And my thoughts on that are that's fair enough. That may be true, but why don't we actually find out if that's the case? And if it's not the case, we can come up with a solution that works for you. If it is the case, great. We can have a discussion about this later. You can take it to the board and you can say, hey, we don't hedge because we did the quantitative analysis of it and we're pretty much naturally hedged. But you also know if one of these revenue streams, for instance, goes away, then maybe that natural hedge is disappearing. And so you might want to revisit that. And so this provides actionable insight to help you have a better informed decision on what you're hedging, why you're hedging. It takes away that element of speculation because now we're actually quantifying what your risk is. So in this case, we're using a natural normal distribution here, just your basic bell curve, day one of statistics, and taking the volatility over one or two of the past years and applying it to these. And in 95% of potential outcomes, 2 standard deviations, you're not going to lose more than 9.6 million. Or FX isn't going to have more than 9.6 million of a negative impact in most cases. If there's tail risk out there, also black swan risk, people call it, but there are occurrences that happen outside of that normal distribution. We saw that during the great financial crisis, for instance, but for the most part, and for you to model your risk, you don't need to go past that 95% confidence level. And so in this case, 9.7 million, is that a material impact to your company? Is that something you want to address? Most companies probably say yes. I don't know if you're Apple, maybe that's just a rounding error. But if nothing else, you have this data now. And interestingly enough, when you go to a counterparty to hedge away this risk, if you're going to hedge this exact exposure here, the counterparty is going to run the numbers and say, oh, okay, we're going to underwrite 9.7 million to these guys. So the banks, GPS, we all use a similar process in how we're quantifying our risk to you. It's a mirror image of the risk that you have that you're looking to hedge. So how do I determine the right strategy for my company? And a lot of times, it's a pretty easy path. What's your objective? And then the next most important question is what's my visibility for my ability to forecast? Do I have good visibility forecasting 3, 6, 9, 12 months out? How about 18 months out? And that will inform the next question, what's the hedge ratio that I might want to use? If I have a pretty high level of confidence in my ability to forecast, I might hedge 80% out for the year. If, like a lot of companies, have great visibility for the next 3 months, and 3 to 6 months out, a little bit less, second half of the year, I got a pretty good idea, but not great. They're going to have a reduced hedge ratio of their forecast. And then you look at hedge products, and a lot of times an indication for that is, am I going to elect hedge accounting? Certain products wouldn't be eligible for hedge accounting. Certain option strategies that, particularly if they have barriers or triggers, those aren't eligible for hedge accounting. So if you're going to elect that, you're not going to even look at those types of scenarios. The other thing would be credit risk. If you're really credit challenged and it's hard to find the credit to actually hedge to the amount you want, you may use an option strategy that is less credit intensive. But a lot of companies, like I said earlier, use forward contracts to do that, and it's a pretty simple process. The other thing is, am I going to do a static hedge, which most companies don't do anymore? Actually, I visited a company 2 weeks ago, and they were doing that once a year, every September. They put down to 50% of their forecasted revenue, and they don't touch it again until the following September. They do it again. And most companies don't do that because you're really susceptible to whatever the rate is that time. So they'll do what's like a rolling hedge. So in example 1 here, we have a hedged fixed percentage of forecast. After month 1, now you've got 11 hedges. You'd add another hedge for number 12. So you always have 12 out there. You're just adding a hedge as one matures. And if you only hedge out 3 months, you might add, then every month you're going to add that 4th month. Example 2, and this is what we see more often, a high hedge percentage at the beginning gradually goes down. You'd use a layered approach to add to your hedges there. And so after month 1, you're going to add a new month 12, and then month 4 goes into a bucket of a higher hedge percentage of month 3, 7 moves into 6, 10 moves into 9. So you're going to do some true up hedges and then a new hedge 12 months out. Next thing I want to say here, and this is probably one of the main elements, don't root for your hedges. I know it's easy to say, oh, we made $2 million on a hedge, but if you're only hedging on an average of 65%, the enterprise lost $3 million, you made $2 million back. So you're not better off necessarily if you made money on your hedges. And also whether the hedge made money or lost money really isn't the indicator of whether it's a successful hedging program, right? You're kind of taking out of context. What you want to do is say, did we meet our objectives? And if we didn't, what do we need to do to get closer to meeting our objectives? And making money on the hedge isn't necessarily the answer there. You look good because you're a good risk manager and you created some offsetting gains for the losses that the enterprise is experiencing, but it's not, losing money on the hedge isn't necessarily a bad thing either, right? And so don't root for your hedges. So almost nobody has hedged more than 100% or at 100%, and so the enterprise is better off if the hedge loses money. So that was my pontificating on that. Now our case study. I'm going simple here. That's the same one we started with. Euro revenues at a US-based company. Sales of 60 million annually. Pretty equal to multiple clients in the Eurozone. All their sourcing's in US dollars. Very little seasonality. They have a high degree of confidence in their ability to forecast sales in the next 6 months, slightly less, 7 to 12 months out. So if a company came to me here, I asked them what your objective is. Say, well, we want to protect margins, and we'd like to, be close to the budget rate. That's what our margins are based off of. And so the way I would address that's with the next slide. Actually, first, I forgot that one of these slides. I got to do step 2 here, quantify what the risk is. And so we'll run this through. The last slide I showed you with the waterfall was GPS's own. This one is from Bloomberg, and it's showing the individual, since it's only one currency pair, it's showing each month's contribution to the total risk. And not surprisingly, there's no very little diversification. But that 60 billion euros over the course of a year, 5 million coming in each month, unhedged, you could lose up to $7.7 million, negatively impacting your margins from the exchange rate movement. So over the last 2 years of volatility, if the dollar went up in value, that euro cash flow could be worth 7.7 million less and still be within the normal distribution bounds. And so is this something that you'd want to address? Probably so. And you go ahead and advance that. So there you see the unhedged risk, 7.7. So here's my recommended strategy: forwards, reduce the hedge ratio for further months out, and then you layer them on monthly. And so their first 3 months, they're hedging 4.5 million euros down to 3.75, all the way down to 2 million. And doing that, now if we apply that hedge percentage to that waterfall, the risk has gone from 7.7 million to 2.6 million. So it's not a perfect hedge. You could get there if you hedged 100%, and that was actually your revenue that came in. But like we said earlier, most companies stay under 100%. I'll let Tim address that a little bit more in his conversation. But this is how I would approach it. I'd probably have a higher hedge percentage than 40 at the end. And if the company was comfortable with that, we could go with that. But I don't, someone might raise their hand and say, well, why didn't you use a collar or some other forward collar combination? Yeah, there's a lot of ways to skin a cat here. I always think the most elegant solution is the simplest. And what I'd like to be able to deliver is a solution that reduces the exposure. And if for some reason my contact at the company wasn't there, he was on vacation or he left the company, that the guy that picked up the program could look at what we're doing and pretty quickly understand it. I don't want to put a client in a position where they have so much, there's so many hedges and different variabilities that there's a lot of variability in what they would have to do, or just it's so complicated they don't understand it. Sometimes the treasury manager makes it so complicated that it seems like the only reason they have a hedge program this complicated is to try to ensure this guy's job. And so I really try to stay away from that. I want simple. This is the simplest solution for it right here. Okay, so here's the set. The top blue area here is the initial hedges. And then after 1 month, we're adding those true up hedges and then the new 12-month hedge. So we're adding 4 hedges basically every month for this program. Now, if you've got multiple currencies and you have this layered approach for all of them, and maybe you have 2 or 3 entities with the same currency hedge, you're thinking, well, that's just a lot of activity I got to do every month managing this. Wow. GPS, we got an app for that. We have a cash flow hedging program, and each entity can input their forecast hedge ratio or their hedge ratios, and our system will consolidate those. And as you go from month to month, it'll provide the new netted true up hedge for the enterprise as well as the new 12-month hedge. And so that's it's a pretty cool system. It really helps manage a layered hedge program. And then beyond that, when you go to the review and monitoring of your hedges, it does a really good job of taking what your forecasted versus actual, everybody. What actually came in against your forecast, and how you would, if you're doing a good job of that, maybe that gives you the opportunity to increase your hedge ratio. If you're not doing a good job of that, then it's like, well, where do I find out? Where's my problem here? So monitoring and reviewing, like I said, this is the second most important thing. The real question to ask yourself, what's the exchange rate that came through the consolidated financial statements? And was that the rate you're trying to deliver? And are you bringing those together? If not, how come? You're comparing the actual, compare the impact of the unmitigated FX movement to the actual impact post-hedge. That's one way to take a look at this. If we hadn't hedged, what would this zero cash flow look like? And we did hedge. What's the delta there? And are we able to increase hedge percentages? So some of the challenges that you have, if you're not close on both of these, part of it is purposefully you didn't hedge the full amount of your forecast. A second thing could be there's forecast error. Somewhere along the line, a revenue stream didn't come in that you expected. But if that happens mid-year, you can adjust your forecast as well. And so that's one of the nice things versus a static hedge with the layered or rolling. You can adjust your forecast as often as you need to. And then sometimes it's just the cost of the hedge is so expensive that it's negatively impacting your numbers. So if you're hedging sales of a currency that has a higher interest rate than the US dollar, that hedge is going to cost a little bit of money. And if they have a much higher rate, if it's an emerging market or something like South African Rand, and you're selling that currency for dollars, that's an expensive hedge. And that could negatively impact what you're trying to do here. And what you may want to ask us is, well, if I don't hedge these sales of South African Rand, how does that affect my risk? Because I don't want to pay $500,000 in hedge cost because of this higher interest rate differential that I have to make up for. So we say, well, okay, let's look at all your exposures, but pull the Rand out of that. It's not hedge the Rand. What does that number come out to? And there's an efficient frontier, basically, of all your hedges and the cost that you can kind of pick where you want to be on that frontier. So that's my my big portion of our discussion today. I'm going to hand it over. Well, first we got a poll question. Has your company applied hedge accounting to hedges in the past? And I'll pass that off to Tim. He's got some excellent comments.
I gotta give compliments, Greg. Anytime companies, advisors are talking about defining objectives for the risk management program, it really warms an accountant's heart when you bring up the topic of let's let's get accounting involved and consider the accounting outcomes and consequences, right? In my experience, and anybody else's out there who's an accountant, you're often the last to find out about some certain things, right? Where it may have been just beneficial, even just from a planning perspective, but maybe even more from a strategic perspective, to have the financial statement perspective more front and center while these programs are being put in place.
Cool. So I will close that poll here. Got about 23 respondents, and the vast majority, looks like 57%, said no to the question. We have 4% yes, 22% saying we currently do, and 17% saying we do not hedge. So,
yeah, a great variety, right? So as we segue to the party portion of the presentation and talk about accounting guidance, I think there's a lot of opportunity to introduce topics, as well as for those who currently do or have in the past as well, reviewing topics as well, as far as the accounting side goes. So what is hedge accounting? Okay, before hedge accounting, you put a derivative on, there's accounting for hedges, right? There's something you have to do, which is marking to market your derivatives, and of course, letting those changes in mark to market values affect earnings as they happen. Hedge accounting is something you get to do if you meet certain requirements and prove that your hedge is expected to and has been highly effective in offsetting what your designated risk is. All right, so for the accountants in the room, we're talking about ASC topic 815 for US GAAP. For international reporting standards, it'd be IFRS 9, IAS 39 would be your primary guidance there. Okay. So again, repeated, hedging activities. So if hedges determined to be highly effective qualify for favorable treatment, and it relates both to how and where we record mark-to-market gain and losses, which are unrealized gains and losses, right? But also the treatment of realized gains and losses, the actual cash flows that are generated from those hedging instruments. Okay, and it's important because, as we see on the next slide, just looking at the mark-to-market gains and losses and how they can impact the bottom line, we see here a chart of the yellow line representing a company's monthly earnings with hedge accounting applied, and the darker line, the gray line, representing that same company's performance with those changes in their derivative mark-to-market gains and losses recorded in earnings as they're occurring, rather than being deferred through other comprehensive income with the cash flow hedging strategy. You can see it can turn very stable performance into somewhat of a roller coaster ride. It certainly introduces, while economically, right, by hedging, you've reduced your risk, you may be introducing or leaving in your earnings another potential source of volatility that investors, creditors, and other stakeholders just don't simply like. Taking Greg's chart from maybe 9 or 10 slides ago and putting the accountant's microscope on top of it here, we want to look at, okay, what can we hedge, right? There's a lot that can happen in the future. And as we're talking about a forecasted transaction, working left to right on the slide, okay, if something is possible, well, that doesn't really, possibly it could happen, possibly it could not. Under accounting rules, that's not good enough to say this is an eligible forecasted transaction to apply hedge accounting treatment to. Okay, so what you need to have is a highly probable cash flow forecasted transaction in order to qualify for hedge accounting treatment. Okay, that can be based on a history of similar transactions contractual commitments, certain resources allocated to new activities in your business, things like that, right? It needs to be very highly probable of occurring. I don't have it explicitly stated within this presentation, but if you miss a forecast, say you're hedging 5 million of euro sales a month, and you only earn 4 million of euro sales a month for a couple months in a row, that from your auditor's perspective is a missed forecast. It calls into question your ability to forecast accurately. And if you do that enough times, typically three times, it's kind of in practice, it's kind of a 3 strikes and you're out rule. You're not going to get to, your auditor can remove the hedge accounting treatment from your books if you've shown a pattern to miss forecasts and inaccurately forecast with your hedging activities. So very important, right? Really look at that. It has to be highly probable of occurring. Working further to the right, a firm commitment really is you have something signed, written, sealed that you're going to provide or receive certain currency on a certain date. That's definitely an eligible hedge. You have a contract in place to perform a transaction. Okay. So cash flow hedge accounting, especially as it relates to foreign currency risk, really can relate to any of these middle categories: probable transactions, firm commitments, but also you can hedge the cash flow component of your monetary assets and liabilities, as well as your cash balances as well. Okay, but as you see, we have a cross section over to fair value hedge accounting as well. A lot of hedging strategies for the purposes of applying hedge accounting, you really can look at it from one side, say, the cash flow side or the fair value side, and you can hedge either risk with the same hedging instrument. It really just boils down to how are you viewing it, and what's going to be the most straightforward and work best for the company's outcomes, because there are slightly different mechanics. But again, for today, I don't want to go down rabbit holes. We're focusing on the cash flow hedge accounting side. So without hedge accounting, our hedged item, our forecasted transaction, if you will, is recorded in earnings when the transaction occurs. Right? So we have a probable future transaction of a big euro-denominated sale next year. We're going to record that sale when it occurs, when the revenue is earned. Right? But if we hedge that without hedge accounting, okay, we have derivative gains and losses occurring from now all the way up until that 1 year point when the actual sales occurs. Okay, and really what's happened, I give this example, it's not going to happen, right? But let's say we execute the hedge today, right? There's a significant market movement next week, and then the market freezes and nothing happens, right? So let's say we have a $100,000 hedging gain. Well, we recognize that hedging gain a year ago. Now today our sale occurs and we have probably a foreign currency loss when we translate that back to USD. So we have a gain 1 year and a loss the other year. That timing is just not appropriate, right? That's going to introduce some volatility to earnings if we can't align the timing of those events. So with hedge accounting, right, no matter what happens in the middle, those derivative gains and losses, the change in the market value as forward rates change, so does the market value of the hedging contracts. Those are deferred on the balance sheet in other comprehensive income until the hedged item affects earnings. Okay, so we don't change how we're recording or how or when we're recording the effects of our hedged item, but on our financial statements, we've achieved an objective too in certainty, right? Our realized hedging gains offset a lower value of our foreign revenue, or if we have a hedging loss, that offsets the higher value of our foreign revenue when we translate it. But either way, we have a known outcome because we hedged, we locked in, we're achieving budget certainty under that generic example. I can't have a hedge accounting presentation without mentioning at least the three methods of hedge accounting that are out there. Again, today we're focusing on cash flow hedges. We're under accounting rules, it's hedging exposure to variability and expected future cash flows. Highly probable, that is. Fair value hedges will hedge your exposure to changes in price or market value from the currency component. So it relates to, if we think back a couple slides ago, it relates to existing balance sheet items typically, or the fair value of a firm commitment that we're obligated to perform. All right, and the third method of hedge accounting under ASC 815 is a net investment hedge, where you're hedging the net currency risk associated with your investment in foreign operations. So when those foreign subsidiaries are translated and consolidated in your financial statements, you can hedge that translation risk associated with having those foreign subs. So getting into the hedge accounting process, going from left to right, thinking back to Craig's 4 steps in implementing the cash flow hedge program. Step 1, step 2, step 3, defining your objectives, quantifying your risk, determining your strategy, all really relates to this first portion on this slide in designing your risk management program, right? And then somewhere between, right, steps 3 and 4, and really even back to steps 1 or 2, we have a process of being required to formally document the hedging relationship if we want to achieve hedge accounting. So really there's inputs from defining the objectives, quantification of risks, what's the strategy, the economic strategy, all those are pertinent to creating a useful hedge designation memo that clearly lays out your objectives and the risks that are being hedged. Okay. As part of that formal documentation too, you have to perform an effectiveness test, so proving your relationship is expected to be highly effective. And then the last step in the process is recording your results. Right? Record the changes in value, the effects of both realized and unrealized gains and losses, as we just discussed, right? And then from there, those results, your financial statements, really become part of that step 4 in monitoring and reviewing. From an economic standpoint, it's likely pretty clear whether objectives are being achieved or not. And from a financial statement perspective, that should mirror that outcome there, as far if it is designed appropriately. Just a couple more things to say about the documentation. Again, you describe the hedging relationship, identify the hedged risk, and you also prescribe a method of assessing your effectiveness. Okay? Usually a regression analysis of rates or forward contract values historically. Really, any reasonable method it is allowed under FASB, but it has to mirror what the actual hedging relationship and objective is as you document it. It has to make sense, if you will. Okay. I've talked a lot about changes in value and market values. So the valuation of your hedging instruments is very important because that gets recorded as an asset or liability. And how that value is determined is just simply looking at the expected future cash flows of your hedging instrument. So today's forward rates dictate what my expected future cash flow is. I record that as an asset or liability. Highly effective hedges, okay, are considered hedges which will offset the hedge risk between 80% to 125%. And then the last part, again, is recording results and just looking at What a basic effectiveness test may look like is really a regression analysis of historical spot rates versus hedged rates, right? Hedged rates might typically be represented by the average spot rate of a given month compared to the spot rate at which you are settling your hedges. So the gray and blue lines on this chart here, obviously same currency pair, it's an average rate versus spot rate analysis. You can expect those generally to be very highly effective, I would say, right? Near perfect effectiveness, just a little bit of differences there. If we look at currency to our orange line, say we're cross hedging with different currency pairs, that orange line versus the blue line, which is likely the currency we're exposed to, those wouldn't be highly effective, right? We see them moving in completely different directions. So pictures can say 1,000 words. Setting strategies and pictures can even say 1,000 words to accountants who just love numbers more in general, right? So this picture would tell most of us that we don't have an effective hedge if currency 2 is any part of that relationship. On to the real fun stuff now. I feel the anticipation building for some debits and credits, so we'll get there. Again, with cash flow hedge accounting, rather than recording derivative gains and losses and earnings as they occur, we record those in other comprehensive income until that hedge transaction occurs, removing that unrealized gain or loss volatility from earnings. So 3 things happen. Contracts that are outstanding at the reporting date, we record as an asset or liability and defer it in OCI in general. Contracts that have expired in the current period, we need to record the realized gain loss impact, right? So that's a benefit to the cash position or accounts payable, receivable, as well as technically still deferred in OCI until that hedge transaction occurs. Assuming that happens at the same time, you reclassify that realized gain over to sales immediately. In general, this is our classic example here. When we execute the hedges, they're considered to be worth 0, as long as we're executing at current market rates, right? So we have no entries to record over in that far left column. When we get to our first reporting period, we have outstanding contracts. We have, just hypothetically speaking, a $10,000 gain in our hedges would result in a $10,000 asset recorded and a $10,000 credit to OCI deferred in the balance sheet. Okay. Let's say period 2, we settle the hedge. Okay, so we have now no asset or liability because the hedge has expired. But what does happen if we settle that hedge at 8,000? You see, we have a debit to cash of 8,000 now, and we've also reduced that OCI balance by 2,000, reflecting that change in value. Okay. And now period 3 is the point at which we reclassify OCI. And this could happen within the same reporting period when your hedge matures, or it could happen the next period, depending on when you recognize that hedge revenue or expense. Okay. And what happens there is you simply zero out that OCI balance. We move that $8,000 gain from OCI into earnings to align with the timing of when we're recognizing our hedge transaction. Okay, what we're left with is a debit to cash and a credit to our income statement. Okay, it should reflect the actual cash events, and that's what's occurred here. One more quick example, revisiting Greg's original strip of forward contracts here, selling euros, buying USD. If let's assume we qualify for hedge accounting first, right? We're going to just assume they're good. Greg set them up, so of course we're good. Let's say at the end of our period, we revalue the contracts, okay? And what that value is the gain or loss is equivalent to, okay, I have a contracted value of USD that I'm going to receive, that I'm going to buy. Okay, how does that compare to the market? If if my contractual USD is, in this example, more than what I would receive in the market, I have a gain. Okay? If I could get a better outcome in the market, then I have a loss on that particular contract. And we look at it at each expiry date, not just kind of a blended overall rate, but each expiry date can result in a different asset or liability. I apologize, my chart got kind of goofed up in technology translation, but if we go to the next slide, what could happen? Let's assume that first line is the January expiry contract, and we're recording results for January 31 month end. Okay. I have a debit to cash because I had a $24,000 gain in that period. And I also credited revenue for $24,000 in that scenario, right? Let's assume I recognize that revenue immediately at the end of the month. So I recognize my hedging gain as well. Okay. What's left over, the other contracts that remain outstanding, we record them as assets or liabilities. And again, as long as they're highly effective, the entire change in value for US GAAP is allowed to be deferred in other comprehensive income. So you see the asset of 80,000 and a credit of 80,000 to our OCI balance. I won't read these word for word, but remember the benefits of hedge accounting, right? It's what I really want to drill in on, and then we'll get to the Q&A. But again, benefits of hedge accounting has to do with recognition of our unrealized gains and losses, and also the timing of our realized gains and losses. Okay. Third, the geography of that earnings recognition is also very important. If we're hedging revenue, we get to net our hedging gain or loss into the revenue section of the income statement rather than carrying it as other gains and losses as we otherwise would without hedge accounting. Right? And if you remember one thing, hedging economically provides us stability and predictability, but hedge accounting can provide us financial statement stability as well.
All right, our final poll question is here. Let me get that into the chat.
Question 3, I would like to learn more about cash flow hedging, hedge accounting, other foreign currency matters, or all of the above.
Looks like we're getting a lot of responses saying all of the above.
I love it.
Well, while those continue to trickle in, let's pull up the Q&A because that's going to be our final section here. And let's start looking at some of these questions. All right. Looks like we had a couple people with some other issues. We were aware of those. Some people with struggles in not being able to get to the poll. Hopefully we got those sorted out. If you were unable to access the poll, I will go back and open in the chat, reopen the other two polls so you can try and get some answers in there. Sorry, it'll pop up again. All right, any other questions, anything anyone wanted to drill into or look at a little bit more? We've got one from someone that says, what is the typical amount of time saved doing something like cash flow hedging in FXpert, which is GPS's tool, instead of using spreadsheets?
Good question. It's individualized to each company, but I would say if you spend 2 hours on the spreadsheets, coming up with your new hedge amounts, and it's multiple currencies and possibly multiple entities as well, that the process is going to be eliminated to under 20 minutes, to be honest with you. The question mark that our technology can't help is really your confidence in your forecast. So if you think, well, I'm going from 90% to 80%, that's going to take you longer than once you put 80% for this forecast for the next 3 months or 6 or 12 months or whatever. and then refigure my exposures. That's done, instantly, quicker than our poll questions. And so it saves a ton of time. If you spend an hour on it, it's going to be, a 5-minute type thing. Where you really get the huge benefit is if you have 10 different entities with 5 different currency pairs, and you have a lot of cross-currency exposures. That's going to take you a lot of time, and it's going to take you the same 5 minutes through our platform. So it's a huge time saver. But another one of the nice benefits of that is the time savings, besides just the efficiency and the net transaction size. But it also creates discipline at the entities as well, for helping them. Now they have skin in the game in delivering on the actual forecast that they're putting into. So it creates a lot of discipline as well as time savings. And those are 2 huge benefits that are outside of any financial impact.
Great. Any other questions or comments? Well, then we will call it there. Thanks, everyone. And like you said, we will be distributing the presentation so everyone can review it later. And thank you so much, everybody.